Well, for everybody who follows me, I'm back, but for some reason, I usually take screenshots to show you the information, and it won't. It uploads on my iPhone. It's bigger. It's like 4 by 3 instead of 16.9. And no matter what I do, I can't fix that. I don't know what to do. If someone knows, please tell me. Okay. So these last three videos on the dollar and the geopolitical, I mentioned again that I believe we're in the three-wave inflation, and a lot of the questions were around why do you believe that, and that's a legit question. I don't know if my answer is legitimate, but this is my personal experience in getting to this point where I believe about the inflation. So here's our inflationary chart, and I came into the business in 1975 there, and I experienced the second and third wave of inflation. I never bought a par bond until 1983. I freaked out. I never bought one at par. And in fact we had OIDs, original issue discounts. So we would actually, a new bond would come out and it would be issued at like 68 or 75 or something like that. An original issue discount, OID, because no one ever bought a par bond, okay, for years. So anyway, during this period of time, there is these analysts out there like Elliott Wave and the Kondratiev Wave, and these were people who believe that there are economic waves in history. And here's a brief discussion. You can read it, but Kondratiev believed that we had roughly a 60-year cycle divided in two, 30 years of deflation, 30 years of inflation, all right? And I remember reading that, and during this period of time, out came a study that went back like whatever it was, 5, 6, 7, 800 years, going 30 years to see if this was actually true in reality. Now, anybody who knows the data that we work with today, imagine doing that. So this was a classic unprovable economic theory based on bad data, but this is what everyone believed. Now, in reading through this, it became that everyone said, listen, for modern finance, 1952 is the key year. So if you go back, we had 1929, we had the Depression, so there was no inflation. Then we started World War II, we had total price controls. Some of the price controls were let off in 47. In 51, Eisenhower ran for president, and one of the planks of the Republican Party was to get rid of the last price controls. And so what happened is he was elected, as you know, and so all our inflationary charts begin in 1952. Okay, so I forgot all about it. So now all of a sudden we're in 1982, and down are coming the interest rates. It was obvious inflation was over and interest rates were dropping. In fact, as I told my clients, hey, this will be the highest interest rates you see in your lifetime. Barely anybody believed it. My traders, though, we stripped some 30-year treasury bonds, 13 1/8, I believe they were. So in those days, it was much more fun to be a broker. You stripped your own zero coupon bond, all right? So different world today, everything packaged. But so we stripped some 30s, and I think it was my second best trade. People made 400% or 500% on that behind triangle, okay? But it became obvious that 2012. So I thought to myself, hey, 1952, 1982, if I'm still alive in 2012, I'm going to look at 2012. So while we're here, why don't we go over here and look at the inflation rate here between 2010 and 11 into 12? It went straight down. It's almost zero, all right? So you had an inflation rate of almost zero, critical point. And here's my favorite chart of all time. This is our Fed balance sheet. And I just want to point out, during the great financial crisis, right, when we first did QE, we went up basically, $1.2 trillion for the great financial crisis. Now take us up here to about 2012, and then to 2014, we went up, I would say, maybe $1.5 trillion. Remember that, $1.5 trillion. Now you just saw what our inflation rate was. It was almost zero. And yet, we started QE again in 2012. And perplexity tells us is that we have persistently high unemployment after the great financial crisis. We started the year 8.3, we're down to 7.8, somewhere around there. We had very low inflation, we just saw that. Interest rates were practically zero, so there was really nothing else we could do except what? They did QE. Maybe the biggest decision the Federal Reserve has ever made in history. We didn't know it at the time, but that's what they did. And the reason that it may be the biggest decision, again, we can see where we went up to 4.5. We tried to start lowering it down there in 2019, okay? Basically, we started doing QT, and then COVID hit, and we went from 4 trillion to 9 trillion in basically a heartbeat, 2 years, okay? And so we flooded the money. Now we're down to 6.6, you can see in the left-hand corner up there, $6,662 billion, all right? So when it was 2012, I was up in New York, I was doing other businesses and so forth, but I remembered 52, 82, 2012, and I was expecting inflation to pick up. And of course it didn't happen because we did QE. And QE is financial repression. That's exactly what it is. And as Perplexity says, is widely considered a form of repression. It suppresses interest rates. It creates a captive market for government debt. So when you're doing QE, guess what? You can issue all the debt you want. Guess what? We did. And then it reduces the real return on savings because, think about it, QE is to put your interest rates below the inflation rate, so your real interest rates are bad, okay? So you lose money for people who save. So now here's M2, and again, let's go back to 2012. It was around 8-point-some trillion dollars, okay? In 2012, 13, about $8.2 trillion. We're $21.9 trillion right now, okay? So M2 is up. So M2 is the liquidity of the market. And do we see the effect? What do I always say? The market is a function of liquidity, and I believe that Bitcoin is also a function of liquidity. And here are the S&P and Bitcoin overlaid with M2. And as you can see, it's pretty damn close, okay? So you can read this, that we have higher to go to the upside. I wouldn't argue with you. Now here's the S&P 500, and if you look up there, you can see the great financial crisis there, okay? But then you have to go up to that little downturn. That's our little downturn that we had in the market in 2012. So this is when we started QE again. I don't know. So I think we repressed a little bit too long. And here's the long bond. We're down around 423 again here. But I want you to go back to 2012, and you can see we're below 2.5%. So we had a little high unemployment, 7.8. We had zero inflation. We had very low bonds. And so we really started hitting QE again. We started repression. So it became my opinion that when we would get hit with inflation, it would be bigger than it was in the past. And I know this one shows us going up to around 7% or something like that, but as everyone knows, we went over 9% and then we came back down. But this is without less food and energy, but we were over 9%. So that was an explosive move. You can see compared to the first over there, I expect 2 and 3 to be just as explosive as this one was. So what does this all mean to us? I still think there is a 30-year cycle around there. It could be 28, could be 35. But then we use financial repression from basically 2012 to 2020. And then after we stopped the financial repression, then the inflation rate started to uptick. Even though we're taking QT and done a great job with it, I still think that we're faced with a lot of inflation because of all the built up money supply that we're throwing in. What do you think? Tell me in the comments and like and follow.